Is it finally the day of reckoning for these financial markets after so many years of resilience? After the pandemic, after a rate hike cycle of blistering speed from the Federal Reserve, and all manner of other would-be headwinds that were so briskly shrugged off by global financial markets. That's what we are going to be asking ourselves here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And where last week the macro calendar was relatively tepid, this week we have every which bit of event risk you could imagine. And the markets are not taking to it kindly. Needless to say, the week starting with quite a lot of fire and fury here. Weakness spread across all of the major indexes, and markets plainly in a defensive mood. Let's take a look at how this compares with what we saw last week and what stage that sets going forward as we look at this week and what we might be in for next. And the performance that we see for last week is, for lack of a better term, a sea of red. We can very clearly discern here S&P 500 down again, 1.1% for last week. NASDAQ, though, the site of increasingly aggressive selling, down 3.5%. It actually picked up steam to the downside last week. And we can see signs of aggressive liquidation, and that this was perhaps not just a stocks sell-off within a broader rise as we look at what happens with yields and the yield curve. Notice here the 2 and 10-year rates, both down by close to 5%. That is not just telling you that maybe the Fed needs to do more now, or maybe the Fed is going to have to do more later, the kind of trade-off we've seen in recent months around U.S. economic data being a little bit warmer or a little bit cooler, where the markets think, oh, well, the Fed is going to cut later, but they'll do more, or cut sooner, but maybe do less, and shifting a few basis points around here and there along a 2-year timeline. No, this is a concerted drop in interest rates across the curve, suggesting the markets expect the Fed will need to do much more to support growth both now and later, implying some kind of an economic downturn is already underway. As if to highlight that point, crude oil also down for a second consecutive week. Gold down 3.6% despite the situation in yield. Typically, gold as a 9-yielding asset tends to take heart in interest rates falling, because when that happens, the opportunity cost to owning gold improves. But not last week. It seems like the markets wanted to sell everything that wasn't nailed down and go to cash and bonds. Currencies down across the board. Even the yen, which tends to benefit from lower interest rates, much like gold does, it was down. Euro was down. To really put the cherry on the risk-off Sunday here, Bitcoin down almost 11%. So just an absolute liquidation last week, with really just cash and bonds, so cash and cash equivalents, seeing any kind of support. And that, of course, speaking to a market that is panicked. Source of the panic? The threat of global recession. We've talked about this extensively last week and went through a bit of a series talking about first why a week back from last Friday, those U.S. PMI numbers that we saw that suddenly showed the U.S. service sector shrinking for the first time in 25 months, why that was such a chill for markets. saw that, but for the U.S. service sector, the second half of last year was marked by slowing growth. The U.S. economy outperformed, but everywhere else, especially the key engines of global demand, the Eurozone and China, weakened and remain weak. So if in fact the U.S. service sector is weakening, and with it the U.S. economy is starting to turn lower, then the global economy is operating with no safety net and is in the process of losing the one pillar of growth it still has left. Not surprisingly, the markets didn't like it and painted the tape as red as it can be. This week, we're going to get updates on the whole lot of that story with macro data to gauge just how afraid we need to be. And it begins in China with the annual National People's Congress. This is a gathering of China's broad electorate. Obviously, we know the Politburo, a set of 24 policymakers, including Xi Jinping, are really running the show. The NPC, the National People's Congress, is a kind of annual gathering of all of the governing apparatus, including the municipal authorities, to make it official and stamp it and announce that indeed these decisions will be the ones approved to go forward. A kind of rubber stamping exercise, if you will, considering how powerful Xi Jinping is individually and the Politburo is as a group with him at its head, and how influential they are over the entire apparatus. And of course, the issue here continues to be that China is stuck without demand. For 7 consecutive quarters now, we can see that nominal GDP growth has fallen short of real GDP growth. Here's that spread looking negative, and that's not what you want to see. Because when nominal GDP, that is growth plus inflation, is going slower than real GDP, growth not including inflation, then the inflation component is negative. And what that means is effectively the entire economy is in the bargain bin. When there is strong demand, prices go up because would-be consumers of all things compete, and that bids up the price as more people want that which is available at any given time, be it capital or goods or at the consumer level, any which thing. This is the opposite. This is an economy-wide discounting, wholesale, of the total value of goods and services produced in China. And that kind of discounting typically coincides with there not being demand, there not being uptake, and the need to try to generate that uptake with lower prices. Now, China has tried every which kind of monetary stimulus to boost the situation. They've cut interest rates. They've lowered bank reserve requirements to make more cash available. They've spent outright money on boosting the stock market. They've improved lending terms for borrowers that want to be buyers of homes and for municipal governments wanting to cover debts and resume infrastructure spending. None of it seems to have helped. If we look at this Bloomberg index measuring the share of new loans in GDP, not only is it falling and hovering at some of the lowest levels since before the pandemic, it is shrinking, in the yellow bars here is the year-on-year rate, at seemingly an accelerating speed. And so credit growth is hardly supportive here. And so people will be watching this National People's Congress very closely. They expect that the deficit target will be increased. That is to say, China will give itself more room to borrow and spend. And they expect to hear a strong commitment to reviving the economy. China's 5-year plan runs out this year. The next one is from 2026 to 2030. They're going to want to hear that there's going to be a greater cultivation of homegrown tech, a greater focus on economic expansion, less browbeating of industry. And if they're not going to get clear signals that China is getting serious, not only about kickstarting growth with fiscal largesse, but keeping that growth sustained by taking a soft touch on the regulatory side and with industry more generally, well, then hopes for China to be an offset in a global recession scenario are not going to get any meaningful lift. Then, of course, we're back on square one with our global recession fears. Next comes the European Central Bank. They're expected very much to cut interest rates by another 25 basis points. As we can see here, all the way baked in that move in the March benchmark ESTR futures. And further easing on the menu through the rest of this year. In fact, we can see between October, December, January, and now, the overall thrust of Eurozone policy expectations has only marginally changed. The pathway for what the ECB is likely to do seems pretty well anchored for the markets. If we look at what that boils down to, it's 82 basis points in rate cuts this year, followed by standstill next year. So that's 3 cuts this year with about a 24% chance of a fourth. That it's this anchored is probably not good news for that same global recession narrative, because the ECB probably doesn't have much room to do any more, even though the latest PMI numbers are showing us that the economy is basically at standstill. As ever, PMIs are in a logic where 50 is neutral, above it is growth, below it is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. We can see the European economy here is at 50 and has been hugging it for quite some time here, with a skew, if anything, to dip under, going all the way back to the beginning of last year. So things looking very, very slow, and the ECB might have wanted to do a bit more on growth there, if not for sticky inflation, which refuses to give way, in part because of resilience in areas like restaurants and hotels, which we can see you'd think would be less stable of an inflationary force when growth is cooling, and you'd think discretionary spending would come in, but that is not what's going on here. So the Eurozone is looking at above target inflation. We just had Eurozone CPI numbers come in over the past 24 hours, warmer than expected, 2.4 versus 2.3% year on year. And that's probably not an environment in which the ECB can really go very far into a more dovish direction. In fact, that's what the stability of these expectations suggests, that despite cooling growth, inflation is sticky enough that the ECB probably can't do much that's different at this point. And so we probably get an ECB that does not give any more of a cheap credit tailwind to the other major engine of global growth that isn't the US in the Eurozone. And then, of course, there is the US itself. First, we are going to get the service sector ISM report. We're expecting to see fairly steady conditions here, but as ever, the concern is a downside surprise. If we think on here, of course, main catalyst for the panic that we've been watching here in the last week and a half, it was, as we mentioned, the woeful S&P global PMI numbers that showed us the weakest U.S. growth in 17 months because the service sector, the main engine of that growth, contracted for the first time in 25 months. And so the expectations here seem to suggest we're going to hold relatively steady, and indeed that was where we came in on manufacturing, though it should be noted here, of course, that manufacturing did slightly undershoot. It did come in a little bit weaker than expected, albeit not dramatically so. The biggest question now is, will the service sector version of this data give us a confirmation of what we've seen elsewhere? Will it tell us the same thing that the S&P Global numbers showed? Will it tell us the same thing that we've now seen in consumer confidence falling off, in the situation with retail sales, which disappointed, the signs of weakening service sector demand implied in CPI and PCE figures? All of these things the markets will be looking at in this data to see, is the U.S. service sector in fact keeling over? And if this is disappointing, then all of these global recession dynamics that we've been talking about, they all get more of a life to them. Same thing goes for the U.S. jobs report at the end of the week. And here we're expecting a little bit of a slowdown in U.S. job creation, 133,000 jobs set to be added. That would be the weakest in 4 months. The unemployment rate seen holding at 4%, and in fact has been in a very narrow range here between give or take 3.7 and 4.2%. So sort of anchored around 4 and largely holding there. This is what we mean when we say U.S. economic data has tended to disappoint. This is Citigroup's index of U.S. economic data outcomes relative to forecasts, and we can see that increasingly we are moving in the direction of disappointment. This index now below 0, suggesting that much as we saw in the middle of last year, we now expect U.S. economic data to be disappointing relative to expectations as a path of least resistance. If that's the case, given how sensitive we've become to these kinds of numbers, then perhaps more disappointment on the way with NFP and with ISM, perhaps that fuels these concerns. And finally, rounding out the week will be a speech from great man himself, Fed Chair Jerome Powell. He's going to be giving an update on the outlook for the U.S. economy, speaking at an event hosted by the University of Chicago School of Business, interestingly in New York. So we're looking here, as ever, at whether the Fed's reaction function to all of this negativity will be fast or slow. And everything that, of course, that we've heard from the Fed going all the way back to November and December of last year has been a song of incrementalism. We're fine-tuning, we're getting close to the end. We just need to make sure that we're on a glide path to 2% inflation. The economy is doing reasonably okay. It's certainly not falling apart. We're not looking for the labor market to weaken any further from here. So we are very mindful to both the employment and the inflation sides of the mandate, and we're going to proceed slowly and look at the data and not overreact. That's been the message from the Fed for months now. Well, now the data is looking anemic and the markets have become spooked. If, in fact, then, the Fed is going to choose to acknowledge this in a actionable kind of way, well, then the markets might be ratified in their thinking here. We can see the total tally of rate cuts expected this year and next clearly demonstrates what we've also seen in yields. More dovishness being anticipated both next year, where we now have a full rate cut on the menu, and this year, where there's 2 of them now cemented in, and we're starting to cautiously entertain the idea that maybe we'll even get a little bit more. So you can see the total tally here is moved out to north of 80 basis points. So we're looking ostensibly at a situation where the market is already telling the Fed, listen, you've got to go. Again, because this is similar to what we saw here last year, Note this is mid-April. Things start to deteriorate on U.S. economic data outcomes. Markets get more dovish. We saw that right here. Here's mid-April. Data starts getting south. Markets get more dovish. So as you look at this then, if the data disappoints and Powell is still incrementalist in his messaging, Fed doesn't tend to jump on quick twists and turns and things unless they look imminently critical, but that's probably not what the Fed is discerning at the moment, then we're looking at a situation where the market is going to say, well, there's an economic downturn, and the Fed is not prepared to do anything about it in a hurry. So more easing. Bake in more easing downwind because they're going to have to catch up to all of this later, which, going back to where we started this conversation, probably means still lower yields, probably means still more of a defensive posture on equities as the hopes for imminent relief go away and turn instead to maybe they'll miss the boat and cut too late. More weakness for cyclicals like crude oil. But the real question becomes the U.S. dollar, because already the U.S. dollar has started to give up some of this strength. And perhaps as we get more rate cuts on the menu, the key difference with last week will be that the dollar weakens rather than strengthens against this backdrop. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may follow therefrom. On with Chris for Futures Power Hour Mondays and Fridays. On with Victor Jones for The Price of Truth on Tuesdays. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com. Commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. Happy trading. Like and subscribe if you're watching on YouTube. We'll be back tomorrow.